It is Friday, April 3rd, 2026. Traditional global exchanges are frozen for the holiday. Yet outside these silent trading floors, macroeconomic risks are accelerating. The U.S. Bureau of Labor Statistics has just released the March jobs report. Because equity markets are closed, this labor data is entering a trading vacuum. With traditional venues offline, this data is exclusively being priced into isolated, highly volatile environments like crypto and index futures. Simultaneously, a primary geopolitical catalyst is unfolding. The conflict in West Asia has escalated, punctuated by a 48-hour ultimatum issued by the U.S. president. The theater of operations is broadening. Reports confirm the destruction of Iran's tallest bridge, alongside targeted strikes against industrial centers in Abu Dhabi and Bahrain. The collision of off-market employment data and escalating military strikes has formed a liquidity gap. On Monday morning, this tension will resolve at the open. The Hormuz toll shifts the baseline for global energy logistics. With transit risks elevated, markets price a stagflationary premium into moving goods worldwide. Because of this toll, the traditional 60-40 portfolio of stocks and bonds is effectively broken. The inverse correlation between the two asset classes has collapsed. The math is rigid. With maritime choke points threatened, Brent crude holds a floor above $113. This adds a layer of inflation to every global economy. Sector performance reflects this regime. Rising 10-year Treasury yields, peaking at 4.36%, are punishing high-beta technology stocks, while defense and energy sectors capture a war premium. Notice the institutional response. Capital is seeking hard assets like physical gold, pushing prices near $4,650, despite the headwind of rising yields. Generating alpha in Q2 involves prioritizing structural scarcity and war premium plays over growth-era directional bets. The impact of this energy tax is regionalized. The Eurozone, heavily reliant on imported power, is undergoing a rapid industrial derating. Look at Germany's DAX 40. The index is buckling under the effective blockade of Qatari LNG exports, exposing the structural vulnerability of European heavy manufacturing. European natural gas benchmarks have spiked 128% this month alone. For the chemical sector, this translates to supply chain paralysis and margin destruction. A similar crisis is unfolding in Asia. Japan's Nikkei 225 closed the week down 1.4%. As a massive net importer of energy, the nation faces economic contraction. The Bank of Japan is in a policy deadlock. They cannot raise interest rates without risking a crash in a domestic economy already affected. This map tracks the result. Institutional capital is systematically draining from these compromised regions, relocating toward the U.S. and the Gulf. This capital flow is bypassing traditional industrial centers, seeking shelter in sovereign energy states. Holding long positions in energy-dependent industrial equities under these conditions is a guaranteed capital sink. By contrast, the Saudi Tadawul Index functions as an anti-fragility play. It is outperforming the DAX and Nikkei by turning the crisis into an advantage. The index is decoupled from Western growth fears. Energy heavyweights here enjoy dividend visibility funded by the $113 oil floor, and they have powerful internal catalysts. The Saudi private sector is expanding at 5.8% year-over-year, providing internal growth amid global contraction. Institutions remain defensive here, however. The threat of drone strikes on critical infrastructure, like desalination plants, forces a calculated, cautious approach. We are also seeing capital rotation into basic materials and steel. Global logistics paralysis has pushed commodity spreads wider, directly benefiting regional producers. In a fractured supply chain environment, sovereign indices that control the physical commodities represent the structural bull markets that remain. Let's examine the Indian Nifty 50. Earlier this week, the market suffered a Black Thursday wealth wipeout in the morning before executing a V-shaped recovery by the close. This chart shows the institutional order flow. Triggered by yield spikes, foreign institutional investors pulled over 5,500 crore rupees out. But a solid block of domestic capital rose to meet it, neutralizing the sell-off and stabilizing the index. Beyond the secondary market, upcoming primary market listings like Geo and Zepto are concentrating domestic liquidity in massive, completely new ways. Institutional funds are currently holding cash to participate in these massive IPOs. This is the primary reason we are seeing lower trading volumes in secondary mid-cap stocks. This domestic wall of money creates a structural floor. It insulates the Indian index, decoupling it from standard global macro panics. Moving from macro fundamentals to micro execution, we need to analyze how institutional quants are positioning for the upcoming options expiry. This topographical map of the Nifty options chain shows the India VIX holding near 28. This elevated fear gauge bloats options premiums across the board. On the downside, a concentration of 1.88 million put contracts at the 22,500 strike acts as a structural support wall. Conversely, heavy call open interest at the 23,000 strike creates a resistance ceiling, capping rapid upside movement. The current put-call ratio sits at 0.82. Historically, when the ratio drops this low during a geopolitical shock, it frequently precedes a short squeeze the moment de-escalation news hits. In this high implied volatility environment, a high probability tactic involves utilizing defined risk structures like iron condors. If the market consolidates between these two walls, traders can extract profit entirely from time decay. In a panicked market, professional alpha is generated by selling overpriced fear to retail traders, rather than guessing the direction of the next headline. The tactical framework for Monday's open follows a gap-down resilience playbook. Monday's initial direction will depend on how the US dollar index digests the weekend's jobs report. Here is the downside contingency. If the labor data runs hot, the dollar index will likely push above 100.50. That will immediately pressure the Nifty back down towards its 22,500 floor. To defend against this, a likely allocation strategy is rotating into the IT sector. Major tech exporters function as a natural hedge against a depreciating rupee. A secondary allocation targets public sector energy stocks. This allows you to capture the inflation of the war premium rather than paying it. The technical lines for Monday are strict. Holding above 22,800 targets a move to 23,100. However, a failure to hold 22,650 triggers a slide down to 22,250. Surviving Q2 means abandoning the expectation of broad market growth. Success requires cash preservation, strict currency hedging, and precise volatility extraction.